Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is a weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The low water mark of the 18th of August was pivotal to the construction of what happened next. Back then, the market failed to break down through the neckline, currently 822, and highlighted in red on my daily chart, of the small but influential October 2021 to January 2022 head and shoulders top. The market chose instead to construct a new pattern, a bull channel, currently 1052 to 1109. This was easy enough to do once prices overcame the short medium moving average, currently at 943. Now remember this moving average, it will pop up again later on. There was a small free zone above at the time, all the way up to the July 2012 high at 957. However, when the market reached the 957 area, I thought there might be issues. You see, 957 is the gateway to a congestion area above between 957 even to 1001, within which has risen the slowly rising long moving average, currently 1002. A lot of this congestion was made up from 2011 and 2012 and was easily breached on the way up in February and on the way down in June. However, back in those days, the congestion did not have the additional reinforcement of the long moving average in its midst, and it is this, along with the upper bull channel line, that constrained the market topside 4 weeks ago. In the process, the market took on a new shape, primarily caused by the weekly key reversal down made that same week. In fact, it's hard to judge if the shape made the weekly key reversal down or vice versa. Anyway, at the end of that week, the market broke down through the lower bull channel line. Plus, it dropped out of the overhead resistance area and even started moving below the declining medium moving average for a while. That's currently at 916. Then, along came last week, or as I like to refer to it, a week of time wasting, but also a week of defining industry. This is a parallel of what we saw in Chicago futures. I'll expand on that shortly, but first I would like to look at part of my commentary from last week that is still seemingly valid, and I quote, "Much like Chicago wheat, though it is not a complete duplicate, this market has two avenues, though there will no doubt be more available eventually. First is a straightforward move down with potential targets for the bull channel. Thus we see a primary target X down in the 903 zone, whilst the secondary harder to reach target X1 is way down below in the 759 zone. The market's not too far away from target X right now. This leads to the second avenue. It is a possibility for the whole of the July today action being not just a flat bottom, but a flat bottom with an extension. Extensions have something like a bull flag within them, and that is what may be just be being built here ever since mid-August. Personally, it looks a little slack as a pattern, but, and it is an untested but if the short medium moving average, currently at 943, manages to hold the market up, and I will add this week the target X at 903 to that list. If it even manages to hold up the market and we then see prices revert back up, well, then this second scenario, the larger bottom with an extension, suddenly looks a lot more interesting. And that's the end of the quote. I finally come to this week's action, and we have seen the market start to pressure the downside, specifically the medium moving average below, currently at 916, getting below this, and it is a short hop down to target X in the 903 zone. However, before we can even start looking there, we need to just consider one other possibility, and that is to look at the action since June as a possible flat bottom pattern with an extension. In this case, a slack bullish halfway hesitation extension rather than a bull flag inside this extension. The idea was not wholly expired, as prices have found it very, very hard to properly move and close below the 920 level. The start of last week gave a gapping move higher. Looked like it might support that idea, but since then nothing other than a move down to sit just above the slowly declining medium moving average. What we have seen since that attempt high is that the support below as well as the congestion above are both still good. We have not learnt now for a second consecutive week whether the summertime flat bottom with an extension is true. It still looks like it might, but nothing this week has helped nor hindered that idea. Minneapolis wheat. Over July and August, we've seen a sideways to lower channeling market, and also not as exciting as earlier in the summer. In early September, we saw the start of another bullish pattern. It seems to have been prompted by the approach at a steep angle from above of the short medium moving average, currently 955. And rather than this moving average acting as a cap on any rise, it instead acted as a trigger for a move higher. Remember, this moving average will show up again later. This move higher seems to have been slower than in the other grains. This is actually a nice segue into the bull channel come ascending expanding wedge pattern formed until early October, which is currently at 1078 to 1183, and the one I've highlighted in blue on my daily chart. I previously called this construction rudimentary, not only because it was then rudimentary, but also because the market is, as I've said earlier, was way behind both Chicago and Kansas City wheat in its construction. You'll need to look back at the flatlining long moving average, currently 1035, and the declining medium moving average, currently 943, to see this. Incidentally, this medium moving average seems to have triggered the limited move lower in early October. Just look at the relative positions of these moving averages compared to the same moving averages in other grain markets to appreciate how, shall I put it, how inferior the actions have been. Anyway, as I said earlier, 4 weeks ago the market broke down through the lower trend line of the bull channel come ascending expanding wedge pattern. This now leaves us with the same two avenues that I can see here as well as in Chicago, Kansas City, though there will, I'm sure, eventually be more scenarios available. The first is the straightforward move down with potential targets for the bull channel come ascending expanding wedge pattern. Thus we have a primary target X on the downside, quite a way lower compared to the other grain markets in the 883 zone. And this leads to the second avenue. It is the possibility, whilst the secondary harder to reach target X1 is down in the 840 zone. This leads to the second avenue, is the possibility for the whole of the July today action to be a sort of rounded bottom. But a rounded bottom with an extension. These extensions have something like a bull flag within them, though to be honest this one is really looking like it doesn't have such an extension in it at all. However, as I said last week, and I quote, here is the key. If the previously mentioned short medium moving average that acted as support as recently as yesterday, so this is last week, or even the 50% Fibonacci line of the August 2020 to May 2022 move at 955, if they do manage to hold up the market, and then we may, just may, see the opportunity for prices to revert back up, then the second scenario, the larger rounded bottom with extension, suddenly looks a lot more interesting. End of quote. I am the first to admit that the current situation sees the market on the borderline of not happening at all, but I feel obliged to still mention it as a scenario, as the door has not been completely shut on this pattern idea, though it's just a mighty tiny gap of light that is showing. All we have seen here since October, much as in Chicago and Minneapolis, all that we've seen is a verification of supports at the 50% Fibonacci line at 955 and this short medium moving average, the one I mentioned earlier. I have a suspicion that this coming week may be crucial in defining whether the market follows on to the bull channel stroke expanding wedge pattern, or it somehow rescues the idea of a bullish halfway hesitation. Watch this space. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.